this video, we'll look at the stochastic indicator. The stochastic is a simple momentum oscillator developed by George C. Lane in the late 1950s. Being a momentum oscillator, stochastics can help determine when a currency pair is being oversold or overbought, although these terms tend to be used loosely these days. As one of the oldest indicators, they have stood the test of times and have become very popular amongst traders. Firstly, set your stochastics to these settings. These are the settings that I have been using over the past 7 years and it has given me the most success, especially on a 15-minute chart. If you are using the template, these settings will already be included. Now, traders are constantly looking for ways to catch new trends or changes in trends that are developing. Therefore, momentum oscillators can provide clues as to when the market momentum is slowing down, which often precedes a shift in trend. As a result, a trader using stochastics can see these early shifts in trend on their own chart. So here, we'll be looking at two ways that you can use the stochastics for your trading. The first way is easy. On your stochastic indicator, you should see two lines, one at the 80 and one at the 20 point. These represent your overbought and oversold regions. So when price falls below the 20, as you can see highlighted in the blue box here, price is considered to be oversold and thus provide us with a clue that we should look to enter into a buy trade. As you can see, this tends to happen very often. Hence, in order to get the most accurate signals from this, be sure to pair it up with other indicators. As you can see in the diagram, by entering at these points, you would have entered into many good trades. Personally, I prefer to enter into the trade when the stochastic has turned and is returning to its normal range, as compared to entering the moment it enters into these overbought and oversold regions. Similarly, when price has become overbought and stochastics has actually crossed the 80 level, it is an indication that you can go short on that pair. Now the second way that you can trade the stochastics is to look for slowing momentum at certain price levels, and to do this, first identify a double top or double bottom. When you are able to do so, such as in this pair over here, go on and then look at the stochastics. Now if it is making lower highs when in overbought, it is a sign that the market is actually losing its upward momentum and provides a very good opportunity for us to enter into a short trade. Here we have another example as I mentioned earlier. The step number 1 is to look for a double top or double bottom. Next, look at the stochastics and again see if there is slowing momentum, such as a lower high in the overbought region. Since there is a lower high over here, this actually provides us with a good place to enter short again. Similarly, if you are able to find a double bottom such as here, look for higher lows in the stochastics. This shows slowing momentum and hence is actually a good place to enter into the market if you're going long. Although these setups tend to be quite hard to find, when you are able to find them, they tend to be very rewarding, as you can actually see in the charts here. Now that you understand what these patterns and signs are and how to look for them on the stochastics, go look at old charts and see if you are able to identify these patterns yourself. Thanks everyone, and I wish you all the best in your